Understanding market structure and liquidity is one of the most valuable skills any trader can develop. Without a clear understanding of market context, even the best-looking trade setups can fail because you're trading against the real flow of price. In this lesson, we'll break down how to identify market structure, define trading ranges where liquidity builds, and understand how price moves from one area of liquidity to another. By the end of this video, you'll know how to read price with confidence instead of relying on guesswork. If you enjoy educational trading content, don't forget to like the video, subscribe to the channel and enable notifications. Also, let me know in the comments which smart money concept you'd like to learn next. Before discussing order blocks, liquidity sweeps, fair value gaps, or any advanced trading concept, you must first understand market structure. Structure is the foundation of every technical analysis method. Without it, advanced concepts lose their effectiveness. Every market exists in one of three conditions: an uptrend, a downtrend, or a consolidation. The first task of every trader is identifying which condition the market is currently in. Once you know that, separating trend continuation, pullbacks, and genuine reversals becomes much easier. Let's begin with an ideal uptrend. In a textbook uptrend, price creates a sequence of higher highs, H, and higher lows, HL. Each bullish impulse pushes above the previous swing high, while each pullback respects the previous significant swing low. Although real markets rarely move this perfectly, understanding the ideal model helps you recognize the same principles in live charts. The uptrend remains valid as long as major swing lows continue holding. Whenever price breaks above a previous major high, it confirms bullish continuation through a break of structure, BOS. The swing low responsible for creating that new high becomes an important demand area because it represents institutional buying before expansion. Correctly identifying major swing highs and lows is critical. These external swing points define the overall trend, while smaller price movements between them are considered internal structure. Confusing internal swings with major structure often leads traders into low-probability trades. The same logic applies in reverse during a downtrend. A bearish market forms lower lows, LL, and lower highs, LH. Each bearish impulse breaks below previous swing lows, while pullbacks fail to break above the previous major swing high. As long as those major highs remain intact, sellers maintain control. Let's make the concept more practical. Imagine price rallies and eventually breaks above a previous swing high. The highest point before the pullback becomes the major high, while the lowest point that started the bullish move becomes the major low. These 2 points establish the external trading range. Everything that develops between these two extremes is internal market structure. If price later breaks above the major high, the bullish trend continues. If price instead breaks below the major low, market structure shifts and the probability of a bearish reversal increases. The reason this major low is so important is simple. It was the origin of the impulse that created the new high. Institutional buying entered from this area, making it a key reference point for future analysis. Now apply the same principle to a bearish market. Price declines and creates a new lower low. The highest point before the sell-off becomes the major high, while the new lower low becomes the major low. These define the external range. Internal swings form between them, but they don't change the overall bearish bias unless price breaks above the major high. As the trend continues, every new impulsive move creates fresh external structure. Internal retracements occur inside the range, but the overall trend remains unchanged until the external structure is violated. By learning to distinguish between external and internal market structure, you'll stop reacting to every small price movement and begin focusing on the levels that truly matter. This foundation will prepare you for understanding liquidity, order blocks, fair value gaps, and precise smart money entries in the next part of the lesson. The next step is to establish one critical piece of context. We need to understand where price is currently operating and where liquidity is forming. That process begins with defining the trading range. The starting point is simple. Before focusing on entries or execution, you must first identify the current trading range. So, what exactly is a trading range? It is not just a box on the chart or a period of consolidation. A trading range represents the area where price is actively delivering and where liquidity is being built. In simple terms, this zone provides the clearest insight into where price is most likely to react once it moves above or below it. And while price remains inside this range, close attention to price behavior is essential. How to identify the current trading range? The first step is to zoom out to at least one or two higher timeframes compared to your execution timeframe. For example, if you execute trades on the 1-minute chart, define your trading range on the 15-minute chart. If you trade on the 5-minute chart, use the 15-minute, 30-minute, or 1-hour chart. If your execution timeframe is the 1-hour chart, define your trading range from the 4-hour or daily chart. This rule is critical. Never define your trading range on the same time frame you use for entries. Identifying a valid trading range. To establish a valid trading range, begin by identifying the most recent confirmed impulse leg that produced a clear break of structure, BOS. In this example, the break of structure is considered valid because before price continued higher, it retraced into the discount zone, trading below the 50% Fibonacci level, allowing institutional buy orders to be filled. From there, focus on the impulsive expansion leg that followed and created the confirmed structural break. Later, when price breaks below the most recent internal swing low formed in the premium area, which acts as inducement, two confirmations occur simultaneously. 1. The bullish expansion leg is completed. 2. The swing high becomes the upper boundary of the trading range. This sequence confirms that the trading range is valid. Why isn't the entire impulse the trading range? You may wonder why we don't simply treat the entire impulse move from the swing low to the swing high as the trading range. The reason is straightforward. When applying the Fibonacci tool from the swing low to the swing high, price never retraced to the 50% level of that impulse. This tells us that discounted institutional buy orders were never filled. As a result, that move does not qualify as a true break of structure. The breakout remains incomplete, making the resulting range unreliable. In this situation, the pullback is simply a temporary pause before price completes its true impulse leg. For a trading range to be considered valid, price must break below the most recent internal swing low, confirming inducement has been taken and the bullish expansion phase has ended. Only then do we have a legitimate trading range that provides reliable market context. Why the trading range matters. Once the trading range is clearly defined, execution becomes significantly more precise. Instead of chasing breakouts or predicting direction, traders simply wait for confirmation. Liquidity sweeps, inducement, and shifts in price delivery now have meaningful context because we understand the environment where price is operating. This is where high-probability execution truly begins. Candle range theory, CRT. At this point, the next step is to zoom in. We move from defining the environment to executing within it. This is where candle range theory, RT, comes into play. So what exactly is candle range theory? CRT is built around one simple concept. Every single candlestick represents its own complete trading range, defined by its high and low. When that candle is broken down into lower time frames, its high and low frequently act as major turning points. This is not random. Those levels are where liquidity naturally forms. Whether it's a daily candle, weekly candle, hourly candle, or even a 1-minute candle, its high and low represent the highest and lowest prices traded during that period. Because of that, they naturally attract liquidity. CRT is not about predicting random reversals. It is about understanding how price reacts to clearly defined liquidity boundaries inside a single candle. Combined with smart money concepts, this creates high-probability trading opportunities. The 3-candle CRT model. The classic CRT model consists of 3 candles, each with a specific purpose. Candle 1 defines the range. The first candle establishes the trading range. Its high and low become important liquidity levels that future price often targets. The upper boundary is called the candle range high, CRH. Liquidity resting above this level is known as buy-side liquidity, BSL, because it contains stop losses from short sellers, breakout buy orders. The lower boundary is called the candle range low, CRL. Liquidity below this level is known as sell-side liquidity, SSL, because it contains stop losses from long positions, sell stop orders. These concepts apply to every time frame. What matters is how price reacts to these boundaries. Candle 2. creates the liquidity sweep. The second candle moves beyond one side of the range. For example, price moves above the CRH. Liquidity above the high is taken. Price quickly returns back inside the range. This movement is called a liquidity sweep. After taking liquidity from one side, price often rotates toward liquidity resting on the opposite side. The same principle works in reverse. If price sweeps below the CRL and closes back inside the range, it often seeks liquidity resting near the candle range high. Invalid C setup. There is one important condition. If the second candle closes decisively outside the range, for example above the CRH, the CRT setup becomes invalid. In that situation, the market is expanding rather than rejecting the range. However, if price fails to close above the CRH and instead returns inside the range, we then monitor the third candle for a potential short opportunity. The candle range low becomes the logical target. The opposite applies for bullish setups. Candle 3 provides the entry. The third candle provides confirmation and execution. Once the liquidity sweep has occurred and price returns inside the range, traders look for lower time frame confirmation before entering. This approach allows entries with significantly better precision compared to blindly trading breakouts. Which candle should you use? One of the most effective CRT applications focuses on the 1-hour candle immediately before the New York session opens. Why? Because the New York session frequently begins by sweeping liquidity accumulated during the London session before reversing direction. This behavior aligns perfectly with CRT. Here's the process. 1. Identify the 1-hour candle immediately before the New York open. 2. Mark its high, CRH, and low, CRL. 3. Wait for price to sweep liquidity outside one side of the range. 4. Watch for price to return back inside the candle range. 5. Seek lower time frame confirmation before executing the trade. 6. Manage risk properly and target liquidity resting on the opposite side of the range. When CRT aligns with smart money concepts, liquidity sweeps, inducement, market structure, and session timing, it creates a powerful framework for identifying high-probability trading opportunities with precision and discipline. However, there's one limitation to the classic CRT approach. It often requires trading against the prevailing trend. While counter-trend setups can work, trading with the trend generally provides greater confidence, stronger momentum, and more consistent high-probability opportunities. So, can candle range theory be applied while staying aligned with the trend? The answer is yes. There is a refined version of the CRT model that combines liquidity sweeps with trend continuation, allowing traders to enter in the direction of institutional order flow. Bullish trend CRT strategy. The first step is to identify a market that is clearly trending higher. Once a bullish trend is established, avoid chasing the impulse. Instead, wait patiently for a corrective pullback. Corrections offer better entry prices and allow for tighter, more logical stop-loss placement. For example, suppose the most recent impulsive move begins from a swing low and rallies to a new swing high. We expect the correction to develop somewhere within that impulsive range. During this pullback, we apply the candle range theory model only to bearish candles. Because the overall market structure remains bullish, bearish candles simply represent temporary corrections rather than trend reversals. For every bearish candle, mark its high and low. Observe how the next candle behaves. If the following candle breaks below the bearish candle's low and closes outside the range, that CRT setup becomes invalid. Ignore it and continue analyzing the next bearish candle. Repeat this process until you find a candle where price sweeps below the candle's low but closes back inside the range. That is your valid CRT liquidity sweep. At this point, both essential components of the setup have been confirmed: the candle range, the liquidity sweep. Now the next question becomes, where should the trade be entered? Precision entry, using a fair value gap. The simplest approach is to enter a buy trade immediately after the sweep candle closes. However, there is a far more precise method. Drop down to a lower time frame. For example, if the setup forms on the 1-hour chart, move to the 15-minute or 5-minute chart. The lower time frame reveals the internal price delivery hidden inside the higher time frame candle. Instead of entering immediately, wait for a fair value gap, FVG, to form after the liquidity sweep. Once the FVG appears, place the buy order inside the fair value gap. Position the stop loss just below the gap. This provides a tighter stop, improved risk to reward, and a more efficient entry. Managing the trade. Proper trade management is just as important as finding the setup. Once price reaches a 1-to-1 risk-to-reward ratio, consider taking partial profits. At the same time, move the stop loss to break even. This immediately makes the remaining position risk-free. Even if the market reverses afterward, your capital remains protected. Allow the remaining position to continue toward major resistance levels, external liquidity, significant market structure targets. Since this is a trend continuation strategy, the objective is to capture the larger institutional move rather than exiting too early. By combining CRT with fair value gap entries, traders gain a structured method for trading in the direction of the trend while maintaining exceptional precision. Bearish trend, CRT strategy. The same concept works in reverse. When the market is trending downward, avoid selling impulsive declines. Instead, wait for a corrective rally. Ideally, this pullback should reach a premium zone where institutional selling interest is more likely to return. Entering from premium provides better pricing, smaller stop losses, higher probability short opportunities. Once price enters the premium area, apply the CRT model only to bullish candles within the correction. For each bullish candle, mark its high, mark its low. Observe the following candle. If the next candle breaks above the bullish candle's high and closes outside the range, the setup is invalid. Continue evaluating the next bullish candle. However, if price sweeps above the candle's high and then closes back inside the range, a valid bearish CRT setup has formed. Lower time frame confirmation. To improve entry precision, move to a lower time frame after the sweep. Look for a fair value gap that forms immediately following the liquidity sweep. This becomes the preferred entry zone. Execute the sell order inside the gap. Place the stop loss just above the fair value gap. Managing the short position. As with bullish trades, secure partial profits once price reaches a 1-1 risk-to-reward ratio. Move the stop loss to break even. This removes downside risk from the remaining position. Allow the rest of the trade to continue toward major support levels, sell-side liquidity, external liquidity, the next significant bearish market structure objective. Bringing everything together. By waiting for price to retrace into a discount zone during an uptrend or a premium zoning a downtrend before applying candle range theory, traders combine three powerful smart money concepts into a single framework. Trend direction, trading with institutional momentum rather than against it. Liquidity manipulation, waiting for liquidity sweeps instead of chasing breakouts. Precision entries, using fair value gaps to achieve tighter stop losses and superior risk-to-reward ratios. When these three elements align, the result is a clean, logical, and highly repeatable trading strategy that follows institutional price delivery and significantly increases the probability of successful trades. Mastering this refined version of candle range theory allows traders to stop reacting emotionally to price movements and instead execute with structure, patience, and precision, the same principles that consistently separate professional traders from the crowd. Common CRT mistakes and real chart examples. Now that we've covered how to apply candle range theory CRT correctly, let's look at some of the most common mistakes traders make, and, more importantly, how to avoid them. Mistake number 1. Using CRT in a sideways market. One of the biggest mistakes is trying to apply CRT in a choppy or ranging market where there is no clear trend. CRT performs best in trending conditions where impulsive and corrective legs are clearly defined. Without a clear market structure, liquidity sweeps lose their significance, making CRT signals far less reliable. Before applying the strategy, always ask yourself, is the market clearly trending? If the answer is no, it's usually better to stay patient and wait for a cleaner environment. Mistake number 2, entering too early. Another common mistake is entering simply because price appears to reverse. A reversal alone does not confirm a CRT setup. A valid setup requires two conditions: a clear liquidity sweep beyond the candle range high CRH or candle range low CRL, a confirmed candle closeback inside the range. Always wait for the candle to close. Entering before confirmation can easily trap you if price continues moving in the same direction. Patience is often the difference between a high probability trade and an unnecessary loss. Mistake number 3. Ignoring market context. Even the cleanest CRT setup can fail if you ignore the bigger picture. For example, major economic news releases, strong daily or weekly support and resistance levels, significant higher time frame supply or demand zones. Always analyze the broader market structure before executing any trade. Context gives meaning to every setup. Without it, even technically perfect entries can fail. Avoiding these simple but critical mistakes will dramatically improve your consistency when trading candle range theory. Nat Real Chart Example 1. Now let's move from theory to a live chart example. Here we identify our first bearish pullback candle. We immediately mark the highest point as the candle range high, CRH, the lowest point as the candle range low, CRL. Now we wait. The ideal scenario is for price to break below the CRL before closing back inside the candle's range. If the next candle closes completely below the CRL, the setup becomes invalid and we simply move on. Looking at the next candle, we can see that price briefly swept below the CRL with its wick before closing back inside the range. That confirms a valid liquidity sweep. With the sweep confirmed, we now anticipate bullish continuation. The next question becomes, where do we enter? Lower time frame entry. To improve precision, we switch to the 5-minute chart. Immediately, much more structural detail becomes visible. The liquidity sweep below the CRL is now clearly confirmed. Next, we look for a bullish fair value gap, FVG, that forms immediately after the sweep. Looking closely, we can see that a bullish FVG has already developed and price begins reacting from that area. Everything now aligns. Higher time frame CRT confirmation. Lower time frame liquidity sweep. Bullish fair value gap. This becomes our buy zone. The stop loss is placed just below the fair value gap, creating a logical and protected trade. Trade management. As discussed earlier, we always secure partial profits when price reaches a 1-to-1 risk-to-reward ratio. At that point, close 50% of the position. Move the stop loss to break even. This immediately removes risk from the trade. The remaining position is allowed to continue following the trend. Even if you missed this specific trade, notice how multiple new fair value gaps formed during the rally, creating several additional opportunities to join the trend. That completes our first successful CRT trade. Real chart example 2. Returning to the 1-hour chart, we identify another bearish candle suitable for applying the CRT model. Again, we mark the candle's high and low. We patiently wait for the next candle to close. Once again, price sweeps below the candle range low before returning inside the range. Another valid CRT setup has formed. To refine our entry, we once again move down to the 5-minute chart. Several fair value gaps are visible. This time we choose the lowest bullish fair value gap as it sits within the discount zone, offering better entry pricing, smaller downside risk, higher potential reward. A buy limit order is placed inside the gap. The trade triggers successfully. Price reaches the first target, allowing us to secure partial profits. Later, the market reverses and hits our break-even stop. The result? No losing trade. Thanks to disciplined trade management, the position finishes at break-even while protecting capital. Real chart example 3. Let's continue searching for another opportunity. Back on the 1-hour chart, we identify another large bearish candle. We apply the CRT model exactly as before. The following candle sweeps below the candle range low before closing back inside the range. Another valid liquidity sweep. We immediately shift to the lower time frame. Now we simply wait for a bullish fair value gap to appear. After a short period, a small FVG forms. We place our first buy limit order. This time we allow for a slightly wider stop loss to accommodate market volatility. Soon afterward, a second fair value gap appears. Instead of cancelling the first order, we place a second buy limit inside the new gap. Both setups align perfectly. The market respects both fair value gaps and continues moving higher. Both positions develop into strong winning trades. Final thoughts. As you've seen throughout these examples, candle range theory is much more than identifying a simple liquidity sweep. Its true strength comes from combining higher time frame trend analysis, liquidity sweeps, premium and discount zones, fair value gap entries, proper risk management. When these elements work together, they create a structured, repeatable trading framework that emphasizes patience, precision, and probability rather than prediction. If this lesson helped you better understand candle range theory, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss future smart money lessons. And let me know in the comments, what trading topic would you like me to cover next?